Hey everyone, welcome back to Corporate Decoder, the place where we make financial reports sound like a thrilling rollercoaster ride. Today we are diving deep into ManpowerGroup Incorporated's latest quarterly report for September 2025. And spoiler alert, it is an interesting mix of challenges and resilience. Before we start, if you love getting straight insights from these corporate documents, make sure you're subscribed. And if you want to dive deeper, grab a coffee and join our Discord community, linked in the description below. This is essentially a quarterly checkup for ManpowerGroup, a look at how they have been doing financially over the past 3 months and the first 9 months of the year compared to last year. Let us kick things off with a look at what ManpowerGroup owns and owes. As of the 30th of September 2025, their total assets stand at a hefty $8.4 billion, a rise from $8.2 billion at the end of last year. Now, when we look at their liabilities, things have shifted a bit. Their total current liabilities jumped from $4.4 billion to over $5.1 billion. This increase is largely driven by a significant rise in short-term borrowings and current maturities of long-term debt, which jumped from a mere $23.4 million to a substantial $747.8 million. This signals they have taken on more short-term debt, possibly to manage immediate cash flow needs. Now let's talk about how much cash they are bringing in and spending. For the 3 months ending September 2025, revenues from services were $4.6 billion, a slight increase from $4.5 billion in the same period last year. However, profits are a different story. Gross profit took a dip this quarter, down from $782.1 million to $768.9 million. And operating profit also decreased from $70.8 million to $66.6 million. Looking at the bottom line for the 3 months ending September 2025, ManpowerGroup reported a net earning of $18.0 million. This is down from $22.8 million in the same period last year. The diluted earnings per share also saw a drop from $0.47 to $0.38. It seems profit margins are a bit squeezed this quarter. When we look at the cash generated from their day-to-day business operations, it is interesting to see a significant change. For the 9 months ending September 2025, cash used in operating activities was negative $283.0 million, a stark contrast to the positive $61.6 million generated in the same period last year. This big swing is largely due to changes in operating assets and liabilities, which used up a lot more cash this year. Essentially, they are paying out more for things like accounts receivable and other assets while not collecting as much or paying down liabilities as quickly. Now, here is a big topic: restructuring. ManpowerGroup recorded $51.6 million in restructuring costs just in the first 9 months of 2025. This impacts profitability directly. These costs are for things like job cuts, closing offices, and other reorganizations. It tells us the company is actively trying to streamline operations, which can be a good sign for long-term efficiency, but it hurts the short-term profits. This next part is quite significant. ManpowerGroup had to recognize substantial impairment charges. During the second quarter, they took a $33.4 million hit for their United Kingdom business and a $24.7 million hit for their Switzerland business. On top of that, they impaired a reacquired franchise right in Switzerland by a whopping $30.6 million, all of which is pretty much gone. This means the value they thought these parts of their business were worth has decreased significantly. These are non-cash charges, but they signal that certain business segments are not performing as well as expected. Let us break down where the money is coming from and where the challenges lie. The Americas segment showed revenue growth of 4.6% in the third quarter of 2025. However, within the Americas, the United States saw a slight revenue decrease of 0.9%. Other Americas countries did much better, with a 15.5% revenue increase. Southern Europe also saw revenue growth of 5.2% thanks to favorable currency exchange rates. France, their largest market in this region, grew by 1.4%, but in local currency, it actually decreased by 4.7%. So currency is helping to mask some underlying softness. Italy, on the other hand, showed a solid 10.3% revenue increase, which was partly due to currency, but also strong underlying demand, especially for staffing services. Northern Europe is facing headwinds, with revenues decreasing by 1.4%. In fact, in local currency, revenues dropped by a hefty 6.7%. The United Kingdom and Germany saw significant revenue declines. This suggests economic challenges in these key European markets are impacting their business. The APME region revenue dropped by 7.5%. This was largely due to selling off their business in Korea. Japan and India, however, showed revenue increases, showing pockets of strength within this diverse region. Now, here is where we look past the currency fluctuations. When you strip out the effect of changing exchange rates and also acquisitions and divestitures, you get a clearer picture of the underlying business. For example, in the third quarter, revenues globally decreased by 1.5% on a constant currency basis. But if you also remove the impact of selling businesses, the organic constant currency revenue actually saw a 0.7% increase. So while the reported numbers might look a bit bumpy, the core business is showing some slight positive momentum once you clean up the data. Let us talk about how much money they have on hand and how they are managing their debts. As of the 30th of September 2025, ManpowerGroup had $274.6 million in cash and cash equivalents. They also have significant access to credit facilities, providing them with substantial borrowing power. Their total debt, however, has increased considerably from $952.8 million at the end of last year to over $1.2 billion. This rise in debt, alongside a decrease in equity from $2.1 billion to $2.0 billion, is reflected in their debt to capitalization ratio, which has gone from 31% to 37.7%. This means they are using more debt to fund their operations, which can increase financial risk. So what is the big picture here? ManpowerGroup is navigating a complex global economic environment. On one hand, they are taking proactive steps like restructuring and selling underperforming assets, showing an effort to become more efficient and focused. The impairment charges are a wake-up call that some parts of their business are struggling. However, the underlying organic constant currency growth in some areas is a positive signal. Their increased reliance on debt is something to watch closely. It signals a need for flexibility, but also carries risk. The company is clearly adapting to changing market conditions. The question is whether these adaptations will be enough to drive sustainable profit growth in the face of economic uncertainty and operational challenges identified in markets like Northern Europe. For now, it looks like a company in transition, trying to balance efficiency with growth in a tough economic climate. Alright, that is our deep dive into ManpowerGroup's latest quarterly report. What do you think about their strategy and the numbers? Let us know in the comments below. If you found this breakdown helpful, give this video a thumbs up and subscribe for more. And of course, join our Discord community in the description for more insights and discussions. Thanks for watching, and see you next time on Corporate Decoder.